Hello and welcome to the ASR Fintech. This episode we cover on insurance-linked securities, the web definition. Insurance-linked securities, ILS, are financial instruments that transfer risk from insurers to capital market investors. The value of ILS is linked to insurance-related events such as natural disasters, and they serve as an alternative to traditional reinsurance. Common examples include catastrophe bonds, CAT bonds, which are a form of ILS that pay investors interest and return their principal unless a specific predefined event occurs. Deeper dive, how they work. An insurance or reinsurance company, the sponsor, issues ILS through a special purpose vehicle SPV to raise capital. The capital from investors is held in a trust or collateral account, which is separate from the sponsor's balance sheet. Investors receive regular interest payments, often with a floating rate, and get their principal back at maturity unless a predefined trigger event occurs. If the trigger event, example a specific magnitude hurricane occurs, the capital in the collateral account is used to pay the insurance claim, and the investors lose their principal. This structure transfers the risk of specific insurance-related events to investors and provides a new source of risk capital for insurers. Explanation of the key features. Alternative risk transfer. They allow insurers to transfer peak portfolio risk to the capital market, supplementing traditional reinsurance. Uncorrelated returns. ILS performance is largely uncorrelated with traditional financial markets, making them an attractive diversification tool for investors as they are driven by natural and insurance events, not economic conditions. Diversified investor base. They attract a wider range of investors, including pension funds, sovereign wealth funds, and asset managers. Variety of risks. While many ILS are linked to natural catastrophes, they can also be structured to cover other risks like mortality, longevity, cyber, and operational risk. Examples: beyond CAT bonds, other forms of ILS include private transactions and other alternative risk transfer structures like sidecars. A finance news has published on Reuters.com on November 20, 2025. Headline: Insurance IPOs hit 20-year high on Wall Street after tariff-driven chaos. In summary, insurance IPOs reached highest level since 2005, their logic data shows. American Integrity and Aspen Insurance stocks surged post-IPO. PE-backed insurers pose for public listings, PwC's bail-in predicts. The article read, insurance companies' first-time share sales on Wall Street hit a 20-year high this year as investors flocked to firms that were insulated from US President Donald Trump's trade war. Predictable cash flows and resilient business model gave private equity firms an opportunity to sell some portfolio companies and offered investors a safe haven as other industries got whipsawed by escalating tariffs, sticky inflation, labor market cracks, and geopolitical turmoil. Apollo-backed Aspen Insurance and American Integrity Insurance, AII.N, were among the first IPOs to trade after Trump initiated a trade war, which sent the market sideways and derailed other debuts. Aspen and American Integrity raised nearly $457 million and $127 million, respectively, in the initial public offerings. A reference from publication by authors Dr. Ian Enright, Professor Robert Merkin KC, as published for the Australian College for Insurance Studies in January 23, 2024. ACRS co-founders finalized third edition of Professional Indemnity Insurance Law. The document read, ACRS co-founders Dr. Ian Wright and Professor Robert Merkin KC have finalized the third edition of long-standing publication Professional Indemnity Insurance Law, published by Sweet and Maxwell, Thomson Reuters in December. Cited in courts and leading commentaries in Australia and in the United Kingdom, Professional Indemnity Insurance Law takes an analytical and solutions-based approach to explain the extent to which professionals are covered for different liabilities. The second edition was awarded the 2008 British Insurance Law Association Book Prize and was described as the most notable contribution to literature in the field of law as it affects insurance. Following their collaboration on the fourth edition of Sutton on Insurance Law, Dr. Enright and Professor Merkin Casey have now completed a significant update and substantial restructure of professional indemnity insurance law. The new edition provides commentary on key cases and the evolving law and continues and enhances the previous edition's consideration of relevant clauses from modern and traditional policy wordings. Explanation for the overview, Part 1, focuses on the law affecting professional indemnity insurance both pre-contract and contract. It examines the relationship among professions and breaks down key contractual principles and terms, including utmost good faith, risk, representations, premiums, and the period. Part 2 deals with the triggers and coverage in a professional indemnity insurance. It covers the main coverage elements necessary in a professional indemnity insurance and to establish a claim, including chapters on third-party loss, cause of action, remedies, and ascertainment of the assured's loss. Part 3 concludes with consideration of claims, illegality and misconduct, and the indemnity and other benefits an insurer provides to an assured in relation to a claim. This has been Dr. Alexander Solomon reading you the ASR Fintech covering on insurance-linked securities. For transcripts and related links, visit alexandersolomonreports.com. Once again, we credit mention for information sources on Google, Reuters.com, and the Australian College for Insurance Studies. Thanks for watching.